Good morning, everybody. We've got the majority of folks on the call. Thank you again for doing EDR from Afar with us. Morning, Marty. Thank you. First thing I wanted to do is give a shout out to our electric cooperative family, in particular, our CEOs. They have, since this whole thing started, I've had the opportunity to sit down on their weekly conversations, and all of them working together, one, to make sure that our employees are safe, and that their families remain safe, but also to make sure that we're keeping the lights on and keeping the power going. We've had a lot of, there's been a few storms that have done some pretty destructive damage across the state, and they're working around the clock, whether it's their crews working or lending a crew to go work at another cooperative. It's just been amazing to watch. And so I think we just had a Lineman Appreciation Month just passed, and wanted to make sure that we acknowledge them. And also the fact that for the South Carolina Power Team, they make all of this possible. So I know my chairman's on the phone. The chairman of Central, I think, is going to be on the call, Larry Hines and Bob Pauling. But I want to be especially grateful to them. So Didi Caldwell is our presenter today. She would have been with us at EDR, and in the midst of all of this, I asked if she would be willing to do the program that she was going to do with us in Hilton Head. Most everybody on this call knows Didi, but for those of you that don't, she comes from that Fleur family tree of folks that started there and left, and it just had amazing careers of their own. She's built an amazing site selection practice that she opened in 2008, I believe. Global location strategies. She's worked deals in over 30 countries, both domestic and FDI driven deals. If you've done a deal with her, you know that she works large load, large industrial projects. It's kind of one of the things she's best known for. She's a Georgia native, now she's been in Greenville for a long time, and that's home to her. She's married to an incredible man named Eduardo, and two boys. They're not young men, they're not boys anymore, but Jonas and Gabriel. She has lived in Argentina, Australia, Spain, and Mexico. Has dual citizenship in Australia and the US. I'm not sure if Ford Graham is on here, but she, for people that know how good Ford Graham can throw down Spanish, I put Didi one above that. She's incredible.
Maybe one below, James, one below.
So if you have a question, you can either send it through the chat box, or you can send it through the Q&A box, and then I'll give you an opportunity to ask it. You can also raise your hand. There's a little, if you hover over your name, you should be able to raise your hand, and I can come acknowledge you. So with that, Didi, the floor is yours.
Great. Thank you. Hello, everyone. I hope that everyone is staying safe and healthy and sane. I know for us at GLS, this is our 8th week working from home. So I don't know that it's ever been this long that I have not been on an airplane, going all the way back to when I had my last child. And I certainly know that this has been the longest stretch of time that I've been with my husband every day. And he hasn't gotten sick of me yet, so that's a good thing. You know, one of the things I wanted to talk to you about is, obviously, when I started planning my presentation for EDR in Hilton Head, I had a completely different concept in mind of what I was going to talk about. And I'm actually going to start this by talking a little bit about what I was going to say before, just to show how things have changed and how some things have stayed the same. Let's see if I can get this to move forward. Okay, so just a little bit about GLS. I know that you know who we are, but our mission really is to bring companies and communities together to promote long-term mutual prosperity. And so we're looking for economic prosperity, obviously, because jobs and investment is good for the community. If the company has a good cost structure there and good productive workforce, they're going to be prosperous. But we also look at the social and the environmental impacts that our projects are going to have. A lot of the projects that we work with are companies that practice good environmental stewardship, and some of them are actually, that's a part of their whole reason for being. So this has become very, very important both to our clients and to us. And we've sort of organized our initiatives around supporting the kind of things that will help communities and companies prosper together. Just a little bit about our 2019 year in review. It was a very busy year for us, as it was for, I'm sure, many of you, and also for a lot of my colleagues in the site selection industry. We looked at 67 countries for some of the, not all of those, obviously, for every project, but for certain projects. That doesn't mean that we were on site or that we looked at specific sites in 67 countries, but we do a lot of global benchmarking for companies where we're looking at potential alternatives globally for them. But we did actively look at 194 sites, and those were in 26 US states and in multiple countries. We were working on about $12 billion worth of planned capital investment, and about $575 million of that announced in 3 projects. One in Georgia, which was an expansion of the J.D. Irving tissue plant, Kairos Energy in Albuquerque, New Mexico, which James knows that area very well. That's a small-scale nuclear reactor company that's early stage, and that's an R&D and testing facility for them. And then a pet food freeze-drying facility in Seward, Nebraska for Schooler. Since then, we've also had another announcement, a $3 billion announcement in Casa Grande, Arizona, for a company called Nacero that makes gasoline from natural gas. And it's a low sulfur, actually it's a no sulfur gasoline, so it's a very environmentally friendly product. So that's what's happening right now. And I'm going to start out, or that's what was happening then. I'm going to start out by saying, what were we seeing way back in January of 2020, which seems like an eon ago? One of the things that we were seeing, as I said, is, you know, a high activity level of projects. The economy was growing very strong. I mean, we certainly had a tight labor market as a result of that strong economy, but things were looking very positive. I saw some constraints on the labor side that might hold our economy back, but we were still feeling pretty good. The one thing that we were seeing was shifting supply chains. So things like the trade wars and talk of tariffs and, you know, some regional skirmishes around the world between players like Turkey and Russia and Saudi Arabia and Iran. These were giving companies a little bit of reason to question these very, very extensive multi-tiered global supply chains. And so even back before the coronavirus happened, we were seeing some talk and some action around shifting these supply chains. And we're also seeing an accelerated interest in investing in North America. I joke sometimes that I spent the first half of my career moving companies out of the United States, and I'm spending the second half of my career moving companies back into the United States. And there are several reasons for that. One of them is the shifting energy landscape. So energy is just becoming a lot more affordable in the United States relative to the rest of the world. And this is almost 100% due to the new technologies associated with hydraulic fracking. When that came online in about 2007, it started to revolutionize the energy landscape, not just for the United States, but for the world, and really change the geopolitical picture as well. We'll talk about in a little while how oil prices and the coronavirus may be impacting that somewhat, but certainly back in January of 2020, this was the case. So when you're looking at anywhere between 4 and 8 cents per kilowatt hour for power in the United States, and other places in Europe, up to maybe 20 cents in some places, and natural gas is just not nearly as widely available, or it's only available at a much higher cost than it is in the United States. So that was definitely something that was leading to interest in the US. The second one was international geopolitical risk. I mean, last year we were talking about Hong Kong and the protests there. We talked about some of the political issues that are going on in China with the Uyghurs out in the West. If you look back previously, you can point to things like the nuclear disaster in Fukushima and how that had a supply chain shock on certain industries, particularly the automotive industry. There were floods in Thailand that same year, which caused geographic shocks to the microelectronics industry. So these things were becoming more common, and the rise of nationalism and things like that were causing companies to take another look. And one of the places in the world where you have very low geopolitical or currency or government risk is in the United States. And then finally, North America just has a growing and stable market. There were some areas around the world, the developing nations in particular, that were growing at a higher rate. But the United States and generally North America has a very long sustained growth cycle, and investors saw that as an opportunity to put their money into a secure environment that would continue to grow over the long term. So that was back in January of 2020. I've heard a lot from, South Carolina that 2019 was not a very good year. And I heard a lot that it was FDI, that the FDI projects were really going down. So I went back and I looked at FDI Markets, which is a product of the Financial Times that we have a subscription to. And we use this both in consulting with our economic development organizations and also to help us understand where we should be spending our time. What type of projects should we, and what type of clients should we be pursuing? So I'm going to put up some slides here for the benefit of James, who is colorblind. I redid all of these last night because oh my gosh, they're two similar colors. So the solid line is the United States, and the dotted line is South Carolina. And they're obviously on two different axes, but I wanted to put them close together so that you could compare the trends.
Do you know how much I appreciate this? Thank you so much.
You're welcome. So this is projects that were announced, it goes all the way back to 2008, between 2008 and 2019 from all sources. So that's foreign direct investment into the United States, and it's also US companies investing in the US or in South Carolina, depending on which curve you're looking at there. The one thing that FDI Markets does not track, which I find is a little bit of a weakness, is they do not track intrastate investments. So if there was a company like Milliken that was headquartered here in South Carolina and they made an investment and created jobs in South Carolina, they would not track that. But it picks up almost everything, and it's definitely good for sort of directional understanding. So what this shows is that in CapEx and in jobs, South Carolina did not do very well in 2019. There was a pretty significant drop off from 2018. And what's really curious about it is that the US, particularly on capital investment, did quite well. Now, I should mention that this does not include merger and acquisition data, so that wouldn't be skewing the answer. So that's curious. So I said, well, let's dig in a little bit further and try to see where that's coming from. So now this is the same charts, but we're only looking at foreign direct investments, so non-US firms investing into the United States. And here we see that although the trend looks a little bit negative in South Carolina, 2019 was about the same as 2017, and it was from a CapEx standpoint, and also in and it was up from 2018. Jobs kind of followed a similar trajectory, although it looks like, generally speaking, the line is moving up and to the right there, which is a good thing. One of the things I want to point out is that if you think about this, these peaks that we have were made primarily by automotive OEMs. So you had BMW and Shaw back in 2008 that announced $3.5 billion worth of capital investment. BMW and GD Tire, which is not an automotive OEM, but is an automotive supplier, $1.5 billion in 2014. So that was the peak after we came out of the recession. Volvo and Mercedes-Benz in 2015, and then Volvo again in 2019 with these are combined totals here, 1.1 billion. So if you take out those significant investments then you would probably see something that's a little bit flatter and not quite so mountainous looking. And what I take from this is that we have a very, very heavy reliance on these really big, multiple hundreds of millions, if not billions of dollars worth of investment, primarily in the automotive sector. So I think there's good news in that we've been able to attract those types of businesses. But I think looking forward, we may not be able to continue to do that. For a state the size that we are, we're probably pretty tapped out on the automotive OEM market. Some would argue we would have room for maybe one more, but nonetheless, I think that relying too much on those types of investments is a dangerous place to be.
Hey, Didi, can you just touch on that a little bit? There's still, as you know, there's still a lot of targeting of potential OEMs in some part of the state.
Mm-hmm.
You just maybe dig into that just a little bit more.
Well, I mean, I think that, you know, putting all your eggs in that basket is not a sound strategy, because there are communities out there that have been chasing automotive OEMs since my predecessor, Bill Dorsey and Ed McCallum, cited the Mercedes-Benz plant in Alabama in the early 90s. And they still haven't won an OEM project. And there are just going to be places that don't ever get there. And I will say, I've got a case study later on that I'll show you that is really for an automotive supplier, but I think it applies also for an automotive OEM. And we're really just constrained on labor. When you start drawing 60-minute drive time radius around automotive OEMs, then it cuts out a large part of the state. And there are other parts of the state that have very small workforce that are just not really well equipped to host an OEM. So I'll get into that a little bit later. This is where what I think is really interesting is that where most of the drop-off was in 2019 was in US firms and their lack of investment or their slowdown of investment in South Carolina. You can see that there was if you look just at US firms, the peak for CapEx was around $3 billion in 2018, and it fell to less than, I don't know, about 1.25 billion in 2019, and the same with the employment. Now, I haven't really dug into that to see if there were some, trend takeaways in specific sectors or specific companies or that sort of thing. But I found this really interesting, that even though I had been hearing that FDI was off, and there may be some timing things associated with when things were announced and when they were accounted for on the state books, but what this really shows is that FDI is still strong. It was really the US companies that had dropped off their investment in the US. A couple other key trends that to note for South Carolina. So key investors account for more than 1/4 of projects. So that goes back to what I was saying about these, big home run type projects. Automotive components is the top sector with almost 1 out of every 10 projects. So we are reaping the benefits, even though we may not ever get another OEM, we're still reaping the benefits of the OEMs that we have here present. Something that I found was surprising is that going back to 2003 to 2020, the largest projects originate from China in terms of CapEx. So the average for all of the projects that come from China, the average project size was almost 131 million people. The top 5 destinations in the state attract about 1/3 of the projects, and Charleston and Greenville account for about 25% alone. So I just put that out there as sort of a framework, because that was what I was thinking in January of 2020 that I was going to be talking about. And there was something that happened in between my planning for this and actually speaking to you today. And that is that we are seeing something that is historically unprecedented. This is a recession that we have decided to go into, and we've decided to go into it in order to protect the lives of literally millions of people around the world, hundreds of millions, maybe even 1 billion people. And that has had an enormous economic impact, but it's also had this supply shock that we have not seen really since World War II. You could argue perhaps that the oil embargoes and the oil shortages back in the 70s were a very significant shock, but I don't think they were as profound, as global in nature, and also as sustained as what we are seeing here now. So this is completely uncharted territory. I mean, we went through this in 1918, but the world was a much different place. So what are we seeing now at Global Location Strategies? It's really a mixed bag. We've had some projects that have continue to move forward. We've had one or two that have been put on hold, one that was just getting started, and another one that was really at the 1 foot line. So it seems like, it's hard to say that we're a microcosm of the larger environment, but if I just look at those two examples, it seems like if you were at the point where you had to commit to spending hundreds of millions of dollars, you were going to stop and think twice about it. And then if you were also at the point where you were going to start a project, you might think twice about it. But if you're in the midst of it, it's kind of like these construction projects that you see out here. You just got to keep going. And at some point you may put it on hold, but we really haven't seen that much other than those two. And we've also seen a couple of new projects. So we're working a new microelectronics project that is, something that I think previously probably would have gone to Asia. And we're looking at some other sort of long-term projects that are associated with energy or minerals or that type of thing. So it's really been a mixed bag. But, I think I've told a few people on this call that, my crystal ball has just been lying to me. So I don't know that I have very much faith in my crystal ball at all these days. So I wanted to look at what are others saying. I don't know if you've seen this, but this was the Site Selectors Guild consultant survey that came out. And they were seeing kind of similar things. I mean, about half were saying that projects had been paused, and about another half said that they were moving forward. They were pretty optimistic that, 100% said that they were either going to start in Q4 of 2020 or sometime in 2021, which may seem, like a long time, but in the grand scheme of things, if we really do get things up and going that quickly, I'll be very pleased with that. But 81% say that virus will have a major impact on global supply chains. And I agree strongly with this. And then I don't work so much in the office space, but there has been a lot of talk about how this virus is going to have an impact on the office space. Some of the hot industries, I think some of them are pretty self-apparent. I'm looking down at my phone because I took a picture today of the television. So if you think about life sciences and pharmaceutical, there are going to be certain industries and certain processes and sectors and products that the country is going to step in and say, we need to have those either located here or in close proximity with friendly countries, rather than relying on primarily China for the production of all of these. So if you look at just an example, 52% of the penicillin antibiotics come from China. And I think this is 52% of the US supply of antibiotics. 90% of the tetracycline comes from China. And they also make a lot of our active pharmaceutical ingredients. So they may not actually make the pharmaceutical, but they're making the active ingredients. And so when you put that in the framework of how we have our relationship has devolved with China, we are very much at risk. I think before the pandemic started, the US really had the upper hand because China depends on us for their economy. If we jack up tariffs, we decide we're not going to trade with China, it's going to hurt the US, but it's going to hurt them much, much more. If you layer in all of this, dependence on them for PPE, for pharmaceuticals, for all kinds of things that we need to get through this virus, it shifts the power back to them a little bit. So I expect to see a lot more of those projects come here. I think it's also a possibility that the federal government will get involved in incentivizing those projects, which is something that we generally don't see. Transportation and logistics, advanced manufacturing, these are the ones that folks expect to be hot. Food and beverage processing, I mean, that was one of the areas we were talking to a few food clients, and those projects went quiet for us. So I don't know how long it will take for them to come back, but
Hey, Didi, on the food and beverage, I'll tell you, we've seen a significant uptick just in the last 2 months,
oh, really?
and it's related to supply chain
Mm-hmm.
and not being reliant on food coming out of Mexico.
Mm-hmm. Yeah, the companies that we were talking to were, it wasn't a play to get out of another country. It was more just shifting within the US. And so that may have something to do with it. I think that they're more impacted by the coronavirus in terms of their markets as opposed to the supply. And that's one of the things that you can look at here. There's a great, I put it on my LinkedIn page, so you may have seen it, but there's a survey of business people that work in the manufacturing sector. The vast majority of them are manufacturers themselves. There's a few distributors. Out of the 1,073, I think about 80 or 90% were actually manufacturers. But they've been doing surveys that started back in February, and I don't know when the April one will come out. But the shift has been that in February, they said that they were impacted by the coronavirus, but their impacts were their inability to get the supplies that they need. And by March, that had shifted to more where they were worried about their market or their ability to produce because of their risk to their employees. But this also confirms that they, let's see, what is this? I think this is how likely they believe that production and sourcing will move back to North America. And you can see how that has changed since February. So there were about 46% of the respondents in January said it was either very unlikely or not at all likely. That number hasn't changed that much. You can see how much the likely has gone up from 23% to 33%. So if you look at this survey, you'll see that a lot of them are smaller manufacturers, so it's not necessarily your huge conglomerates. But I think that's telling that they are also thinking about shifting either their production or their source of supply. So what are we watching right now? So there's a few things that I think we ought to keep our eye on that are extremely relevant and are going to have a big impact on both the economy of the US and the global situation. So James and Stevie and Eduardo and I had a virtual happy hour a few weeks ago, and I said, oil's going to go negative. And I didn't come up with that. I was reading some very smart people that said oil was going to go negative, and you know what? It went negative. And just to put this in terms of, historical perspective, I put these charts up here. So the first one is the price of oil over time, going all the way back to 1870. And you can see that even when you do not adjust for purchasing power parity or real terms, this is completely unprecedented. I mean, since the 1970s, we have not seen oil anywhere close to this low, much less negative. And then the second chart just shows when you adjust for the time value of money, then again, it's even more striking. What does this mean? Well, for one thing, it means that the oil and gas sector in this country is suffering mightily. And there are regions like the Permian Basin, the Marcellus and the Utica, that are the Bakken, that their economies are suffering significantly because of this. It also means that potentially, so my husband is in the natural gas business, and he came home last night and he told me natural gas went up, which is words I have not heard in many years. And what I believe that is, and I haven't confirmed this, I need to do a little bit more research, but if you think about natural gas, when they're doing fracking, they're really going after the oil and the natural gas liquids. The natural gas is almost like a waste product that they're either going to flare or they're going to put it in a pipe. So we are almost getting our natural gas for free these days. We're just paying for the transportation of it from the source to wherever we're going to be using it. That's why West Texas Intermediate and the shale plays out there. That's why that is the cheapest place, one of the cheapest places for natural gas, is because that's where it's coming out of the ground. I suspect that because a lot of those wells are shutting down, that there's just less supply. Because if you're not pulling the oil out, then you're not pulling the gas out either. So I think that's definitely something to watch, because it could increase our cost of energy, both because so much of our electric production has shifted to natural gas, but also because companies use natural gas to a large extent in their processes, either for heat or as a feedstock. What this means for the world is not very good. The United States is strong enough and diversified enough that this is going to be okay. But if you start looking at places like Alberta and Canada, you start looking at Russia, Iran, Iraq, Saudi Arabia, Nigeria, Venezuela, these places are likely to see severe economic consequences. Saudi Arabia and the Emirates and things like that, they've got a very large bank account that they can draw upon. But Nigeria, Venezuela, some of these others are going to have significant unrest. There's even talk of famine, all kinds of things. So it's another reason why the global supply chains are at risk when there's a lot of regional unrest. The other thing is the food supply chain. So James, you talked about this previously. Wendy's has run out of hamburgers in some of their locations because they use only fresh hamburger. And if you're old enough to remember this commercial, you know what it's about. But certainly the food supply chain is being impacted. But we in the United States enjoy an incredibly robust food supply chain. We have the largest expanse of arable land in the world that is connected by a system of rivers, and we are able to produce and move food around like nobody's business. I'm not saying people won't go hungry in this country, but they won't go hungry because the food supply chain has broken down. That again is not true for the rest of the world. The rest of the world has a much more fragile supply chain. There are many places, many countries that do not have good arable land that they can grow food and also feedstock for animals. These are also places that, as their economies have improved, they have shifted to more proteins, which means that they're eating a lot more animals, and they import a lot of food from the United States, particularly corn, to feed those animals. So when this coronavirus and production is impacted, and it's just another thing to layer on to the international picture that looks a little bit concerning. The other thing we're watching is, this job loss thing. I mean, it is unprecedented. Even in the financial crisis, you can see on this middle chart here that this one right here, there's some people that anticipate lots of agreement out there that the unemployment rate could go up as high as 16%. And I just took this from The Economist yesterday that says some 20 months from now, unemployment may still be close to the peak reached in the aftermath of the financial crisis. So in 20 months, we may just be getting back to where the peak was during the financial crisis in 2008, 2009. So it's a little bit of a scary thing. I mean, how to put these people back to work. There's going to be a huge percentage of the population that is impacted by this. And can we help train them? Can we help connect them, and so that they can continue to improve their skills and get back to work sooner rather than later?
Didi, do you think there's an opportunity to move some of these folks that were in jobs that had no benefits? I think about the number of people displaced by the service industry. Mm-hmm. Now realizing, oh crap, I've got no benefits. I've got no health insurance. Is there a chance to move these people into the trades?
There is, but they're not going to do it by themselves, I don't think. I mean, right now they're collecting sizable unemployment checks. which I know a lot of people argue with, but there was this idea that we want to pay people to stay home, and that's why there's the bonus there. But eventually they're going to have to get back out there. And I should mention too that 16% assumes that 8 million people are going to drop out of the workforce, so it doesn't even account for them. So how do we keep those people engaged? How do we improve their skills? I know that down in the Golden Triangle in Mississippi, their communiversity, they're looking at ways that they can transition the high school students, the ones that are going to be graduating this year, transition them into a technical program for the summer while still practicing social distancing. So they have a huge space. They're going to rotate their classes, offer more classes, so they'll have fewer people in there and separate them to try to capture that, that workforce there that could potentially just kind of get lost in the shuffle. So talked a little bit about this. This is the shifting supply chain concept. James, what time do we have till 10:30, right? I think that's right. So the shifting supply chain, so building up your safety. So if you're worried about your supply chain and an interruption to the supply chain, there's a number of things that you can do. None of them are free. But if you want to build resiliency, which is a buzzword that used to be a buzzword, and now it's a buzzword again, is you can build up your safety stock. So just stockpile more things. It's not very in keeping with the whole lean manufacturing concept, because that's where you want to just in time or just in sequence and eliminate excess inventory. But when you do that, you're at risk for any type of supply chain interruption. So you can build up that safety stock. You can build or source a redundant supply. So we did a vaccines project for a company a few years ago where we looked at, they had all of their vaccine production in one location in Europe. And they were considering building another redundant facility simply to have a second source of supply. And that was going to cost them $1 billion. In the end, they decided not to do it, but I bet those plans are being dusted off again and they're rethinking that. So you can build redundant supply at a cost. And then the third option is to collapse the supply chain geography. So I was on a panel last year with a lady from Toyota, and she said that they were committing to making where they sell. And so I wonder if Toyota is now looking at it and saying, in addition to making where we sell, we're going to buy where we make. That's a question mark. They didn't say that. I'm just surmising that they might be saying that, and other countries might be saying it as well. This is the Boeing, I think this is the 787 supply chain. And I mean, you can see that it is truly global. And this is just scratching the surface. This doesn't even talk about, the carbon fiber that's made by Hexcel or Toray in either South Carolina or Alabama. I mean, this is just the tip of the engine. So you can understand, I don't think you can put a 787 on the runway if every single one of these pieces isn't attached to the airplane. It's not one of those things you can be like, oh, we'll just leave that off. So you can see how that is highly extended and highly susceptible to any type of supply shock, be it regional or global. I think that companies have consistently underpriced the risk associated with these multi-tiered global supply chains. I had a professor, I don't know if anybody had Dr. Kwok at the Moore School of Business in South Carolina, but I had him for advanced topics in international financial management. And he had the most beautiful handwriting, and he would come in and write on the whiteboard or the blackboard, if anybody remembers what that is, all of these formulas to help us understand the risk that is associated with investments in international locations. You have currency risk, you have delivery of supply risk, you have government risk, you have labor risk. There's all kinds of things. And I think that companies are now looking back at how they calculated their estimated internal rate of return, and maybe rethinking how they're going to assess and calculate that risk. This is another thing that I think is really interesting. And it's the last thing that I'm going to talk about in terms of what to watch. And that is the euro dollar exchange rate. So this is, you know, how many dollars does it take to get a euro? So when this number is low, that means the dollar is strong. When it's high, that means the euro is strong. So this goes back to, I don't know, 2010 or something like that. So you can see that, you know, we were pretty strong here. The dollar was pretty strong. It started getting a little bit weaker in 2018, which is good for our exports. But it's really starting to get stronger and stronger pretty consistently. There's been a lot of volatility in the last 6 months. But if you think about this in terms of the fact that we have put a stimulus package together of trillions of dollars, and it hasn't impacted the value of the dollar at all. Europeans, because of their form of government and their inability to agree on anything, have not been able to do nearly as much from a stimulus standpoint. Regardless, investors around the world believe that the US dollar is just as strong as it was before before the stimulus package, because they see the dollar as a safe haven. So there is a demand for US dollars, as you can see from the lack of instability in the exchange rate. So that also tells me that investors are not just looking to put their dollars here in like buying bonds, they're also looking to put their dollars here in bricks and mortar and production capabilities. So at the end of all of that, you know, what do you do? So keep calm and embrace the chaos. And I'm going to go through just a couple of 4 ways that you can do that. Use this time to become investment ready. Invest in your inventory and your ability to market them. Get a better understanding of where and how you compete so that you can better target the types of industries, the type of sectors, the types of companies, the types of jobs that you want to pursue. And then that will help you and that will help inform you of how your product, your sites and buildings and infrastructure should be developed to support that. Take care of your existing industry. I didn't show it here, but you know, if you go back in FDI and you look at expansions versus new investments, if you take out those multi-home runs, the expansions, the companies that are already here those are the ones that are the bread and butter of your economic development. And many of them may be hurting right now. So make sure that you're taking care of them. I just said 2 birds in the coronavirus bush are useless. Shore up your budget. This is something I'm really worried about. You know, resources are constrained. So how are you going to make sure that you can continue your economic development activities in the future, regardless of the shortfall in revenues? So building your inventory. So yes, I am still searching out for the site that is the Holy Grail. If you haven't heard me talk about that, it's basically a site that, you know, a big tissue project could go on, but it has rail, it has interstate, it has lots of people, it has air quality attainment, it has lots and lots of water, it has the ability to discharge a lot of water, it has huge electricity demands, it has a big footprint, and it has a lot of natural gas demands. I mean, just it has everything, and it's really, really difficult to find that site. So that's my Holy Grail site. And James, you know, really, they're on me to try to help me find that site.
How big? How many acres are we talking about?
200.
I hope y'all are listening.
Yeah, if anybody needs the specs on what the Holy Grail is, just email me and I'll send it to you. But be thinking about, you know, I think one of the things that I don't know this, I don't have any empirical data, but I think that one of the reasons that South Carolina has not done well, there's definitely a resource constraint on labor, but I think there's also a constraint on the quality sites. And so I just want to encourage you to continue the process of identifying sites, evaluating them, getting them through the due diligence and acquisition, marketing them. And then when you get to the point where you're about to start marketing a site, you need to be looking for its replacement. Because if you wait until a project has come and a project has announced, and then you start looking for a site to replace it, you are out of the game for 2 years probably. So just keep thinking about that. One of the things that we have done, so we started doing virtual site visits in about 2012. And we did it for a number of reasons. And one of them was that the main one was that we wanted to be able to go see sites more quickly and more efficiently than doing the consultant type site visit. So we started using Google Earth, and I think back then it was maybe GoToMeeting that we were using. It was very rudimentary at the time. But now that the coronavirus has hit and everybody's doing, virtual visits, we look like, we were brilliant. We were way ahead of the game. Some of the unintended benefits that we found is that two things. One, we were able to evaluate more sites in that intermediate process before we do site visits than we had been able to previously because of time and budget constraints. So that gives more communities the opportunity to get in the game. The second thing that it has done, it has allowed our clients, if they want to, and many of them do, to participate in the site selection process and the vetting of these sites and the prioritization of these sites much earlier in the process, because they will often attend these virtual site visits with us. So just recently we were thinking, well, what could we do to help the economic development community now? And we've decided to take something that we've been doing on the corporate side and offer it to communities at a very reasonable price point where we send you an RFI, you fill it out, we help you coordinate the virtual visit. We have about a 2-hour virtual visit where we're grading you on your use of technology, your coordination, how well you knew your site, knew the information, how well your team was organized, were they all singing from the same hymn book? Because one of the things that we really pick up on when we're doing these virtual site visits is how well coordinated is the team. And we've had clients that just say, I don't want to go there. They're not working together. Even if they do have a good site, a good value proposition, I can foresee that we're going to have some resistance there. So sharpening those skills and being ready for the actual site visit is something that this will help you do. Does anybody recognize where this site is? Anyway, it's the one in Georgetown. I can't remember what it's called now. Sandpit is what it used to be called, but I think it might be called something else. But anyway.
Hey, real quick, Didi. I think I'm off mute. Yeah. For the community folks that are on here, if you are wanting to do something like this for your community, we participated last year with Kershaw County. Mm-hmm. So we helped participate in a portion of the costs attributed to their team spending the day. And then we did an evening program for all of the business leadership and elected officials in Kershaw. So if that's something you'd like to do, Caroline Warner on our team can help make that happen.
Great, thank you. And this is at an even lower price point. This is a virtual visit, so it's not as good as an in-person, but it's one of the things we can do now. But we do this for $1,500. So it's at a lower price point than the all-day visit and evening presentation, that sort of thing.
So I was referring to the in-person visit. So with both of these, but in person, if you can do an in-person visit, I think it really does a lot for your leadership to see it and hear it from her perspective or consultant's perspective.
Mm-hmm. Oh, thank you. So I was talking about, knowing where you compete. So I wanted to take you through a little example of our location benchmarking, which is in the automotive industry, and I think will be very helpful, and then we'll wrap up and open it up for questions. But when we're making a location decision, or we don't make the location decisions, our client make the location decisions. We just advise them on, it really boils down to these three things. Once a site in a community passes the must criteria, so it doesn't have a fatal flaw, then we evaluate it on three factors: the quantitative or the financial, so how much is it going to cost at this location to build and operate this facility; the qualitative features, which are, what about the labor and the availability and quality of labor? How conducive is the site and its access and its utilities to giving me a good operating standpoint or easy to construct? What's the environmental issues that I'm going to face? These things that can't really be measured with cost. And then risk. And when we look at risk, we're looking at location dependent risk to schedule, budget, and their ability to operate, construct and operate. So for example, with site characteristics, the financial might be the cost of the site, the cost of the infrastructure, the cost of site prep. The qualitative might be how well it lays out. Is it impeded in any direction? How does the access? Do we have more than one access? Do we have to go over an at-grade crossing? Those are things that really you can't measure in terms of dollars and cents, but do have an impact on your business. And then the risk is, well, they've got to extend the water line, and what's the risk that they don't get that ready? Or what's the risk that my permitting for, my wetlands remediation takes longer than I've expected, and impacts my schedule to get up and running. And when you look at all of those things together, then you're looking for the place that has the lowest cost, the highest quality, and the least risk, which is kind of this little triangle right here. But to the extent that you can't find that, you have to really understand what the trade-offs are. And that's our job, is to help them understand those trade-offs. So we look at about 850 data points throughout the whole process. Site selection, some people call it site elimination, because we're putting all the alternatives in at the top and we're waiting to see what comes out the bottom. And your objective is to make it to be this site that is selected. And we end up with something that looks like this. It's a 2x2, where the qualitative score from low to high on the x-axis, and then the operating cost, or it could be total cost, investment cost, from high to low on the y-axis. So you want to be in this up right-hand quadrant, which some of you have probably heard me that I call this heaven. Down here, which is high cost and low quality, that's hell. And then these are in purgatory. And then the size of the bubble is the risk. So you want a small bubble. So in this case, Site 1 and Site 6 seem to optimize, even though they're not the highest qualitative score and they're probably not the cheapest, but they have the best combination.
Didi, you got a question from Courtney. Courtney, you got your hand up. Do you still want to talk? You can unmute yourself. Right now, I will tell you that,
Good morning. Sorry about that. I didn't mean to raise my hand. I think I got excited with the Pennyroyal shout out. This is amazing stuff. Thank you.
that's funny. When you asked, does anybody know where this is? And there's about 10 people chimed in with Pennyroyal.
Good. Sorry, I couldn't.
Back on mute.
Appreciate it.
So I wanted to walk you through just an example of this. This was an automotive supplier that we were looking at in the Southeast. And this is the conditional. So this was a benchmarking. We did not have a specific site. We were looking at counties. And these were the quality aspects that we were looking at. So logistics, workforce demographics, educational attainment, manufacturing presence, and attraction and quality of life. Obviously, this is a very labor-intensive project. They were going to employ hundreds of people. So you may be saying, where's utilities, or some other things, where's site characters? Well, I didn't have a site, but utilities for them, it's a pretty vanilla operation in terms of the requirements on the utilities. And since we didn't have a specific site or building, we focused primarily on the logistics, the workforce, and the quality of life. And I would put manufacturing presence as part of that, workforce, the familiarity with the industry. So 14 South Carolina counties were included in the analysis. Why only 14? Well, first of all, they had to be more than 30 minutes from an OEM or competitors to this particular operation. So that excluded quite a few, as you can imagine. They had to have at least 25,000 in their workforce, and they had to have 2,500 residents working in manufacturing. And the manufacturing location quotient had to be greater than 1. So that's how we got, there were a lot of counties that were excluded because of the OEM radius drive time, but there were also some that were eliminated because of those other factors. So of those 14 South Carolina counties, 5 of them scored in the top 26 of the 79 counties overall. And you can see over here, I just highlighted them yellow so they're easier to see, but these are the scores. And you can see the counties that were included. Spartanburg was in here just as something to it really should be 4 South Carolina counties, because Spartanburg was really not under consideration. It was just being used as a benchmark. As you can see, this is, there were a lot of North Carolina counties in. There were quite a few Georgia counties in. Georgia has a gazillion counties, for one thing, but North Carolina had a lot of counties in, because guess what? They don't have an OEM, so that's good for them, I guess. Then on the cost assessment, we were pretty much looking at payroll, because that's what really drives their cost. There was about $5 million between the highest and the lowest overall, but there were about $4 million between the 5 South Carolina counties. And you can see that some of the most costly labor was in South Carolina. I think this was actually Spartanburg, but there were other counties that were much more competitive. So when we put this all together, you can see that South Carolina is the light blue, so you can see the distribution. This was the benchmarking location here. This light blue here, I will tell you, that was Lexington County, and that was the only one that scored better and was lower cost than the benchmarking location. The next thing we looked at was risk. So we looked at natural disaster risk, and we use this all hazards risk when we're just looking at a county basis. When we get down to a specific site, we can be a lot more specific about flooding and tornadoes and all kinds of things, but this is just at the county level. So South Carolina, I mean, there are some locations, particularly around the coast, that have more risk. There's some flooding issues. And you could argue that the larger the county you have and the more development you have, it automatically ticks up your natural disaster, because you've got more there that could potentially be impacted. But this is a good benchmark for us to use. Then we also looked at wage growth, and this is just Mobile County. Here is just an example in Alabama. What we were looking at is the rate of wage growth from Mobile County within the last 5 years relative to the United States. So you can see that Mobile was growing faster than the US average until about 5 years ago, and then it sort of flattened out and the US average is coming closer. That for us is lower risk, because it shows that there's something that's sort of keeping that wage growth, the acceleration of the wage growth, down. If we had seen something that was opposite, where it's growing faster than the US average, then that gives us reason to think that there's more risk, that whatever cost number we have used in our analysis on the cost side is going to be exceeded in the future. So that represents a higher risk. The other thing we look at is labor availability. So ideally, we would like to have about 50 candidates for every opening that's going to be created by this investment. Less than 50 represents a potential shortage. So we're looking at, for example, material moving workers. In Mobile, they had 6,734 employed, 507 employed, and they were going to be creating 147 material moving positions. So that equaled out to 49. So that's pretty good. The lower that number is, the more risk there is. The higher the number, the less risk there are. I will tell you that in some projects, we're looking at welders and electricians and things like that, and we're looking at numbers like 2 or 3 or 5 candidates per opening. That gives us a lot of heartburn and a lot of reason to be concerned. And then this is the composite with the risk. So Lexington County here did have some, I think it was on the labor availability standpoint that where they had the highest risk. So this just gives you an idea of how we present this to the client. And then the next phase would be to focus on these counties that are in this top right-hand quadrant to start to evaluate, to identify and evaluate sites. A couple other things. So the last couple of things that we were talking about was, supporting your local businesses. So this is just from the U.S. cluster mapping, and it shows that 63% of South Carolinians are employed in local clusters. So those are the foundations of your local economies, and those are things like restaurants, hairdressers, local insurance, car mechanics, etc. And then you have about 37% employed in traded clusters, and that's pretty similar to the U.S. So that's good. Because this is really the engine of your economy. So they put us in an example here: aircraft manufacturing, management consulting, anything that does business and trades outside of the local region. And you can see that more income comes from the traded clusters, as well as more patents. Almost all the innovation happens within the traded clusters. So both of these are going to need support during this time period, but understanding where they fall and what kind of impact that it can have down the road is important. And then, avoiding the chopping block. So I pulled this information from the National Conference of State Legislatures, and April 9th, they had anticipated that tax revenues were going to fall about $500 million, or 15.5%, in South Carolina, assuming that the U.S. gross domestic product declines by 20%. The general fund revenues could decline by $643 million, which is 257.5% below February estimates. I haven't really dug into what those numbers mean, but I just encourage you as economic developers to take a hard look at, where you get your revenues. A lot of cities have a business license, which is basically a gross receipts tax. They get money from sales tax. They get money from parking tickets, admission to the zoo and all kinds of things. So hospitality tax. So, just depending on where your revenue comes from, this could be a really lean year. I've talked to some economic development organizations, and they feel pretty good because what's happened is their travel budget has just evaporated because they can't travel anywhere. So, you might want to think about how you hold on to some of that money or spend it more strategically in order to advance your economic development missions, because I truly believe that this is not a period to take your eye off the economic development ball. As some of you may know, I like to end with Winston. He's one of my favorite world leaders ever, and he's got great quotes. And I just think that this one, while I could have put up there, when you're going through hell, the best strategy is to keep going. That was also attributed to Winston, but I think that this one's, this is a little bit more of a somber moment, but I think we shall persevere, and hopefully we will come out of this into the sunlight broader and more genial and more lasting than mankind has ever known. So thank you very much, and I'm happy to take whatever questions you have.
I'm not sure if we have any questions at this point. Can you just real quick touch a little bit more? You said it's important not to take your eye off the ball. Mm-hmm. I think that's something that the longer this stretches out, people are figuring, okay, how are we going to squeeze it all into the fall, right? Everything that we've had to put off. And I'm sure you and your colleagues are asking yourselves the same question: how do we get it all done? Do you have any words of wisdom for folks?
I guess it depends on what get it all done means. If you're going to try to hit all the trade shows, that you were going to hit, I don't think that that's going to be even an option. And I don't necessarily know. I don't know how well attended those things are going to be. In the Site Selectors Guild, we're moving forward, assuming that we're going to have the fall forum in Richmond, but we are also doing contingency planning in case that is not able to happen. We moved our annual conference from March to June of next year, just to give some more flexibility and maybe hopefully time this whole thing a little bit better. What I see out there in terms of site development is, I think you can move forward on that now, moving forward with identifying sites, characterizing sites, making them more investment ready. If you look around, the construction activity has not stopped at all. And so I think that all of your environmental firms and civil and things like that, they're willing and ready and able to do whatever you need them to do. I do think that some of what you need to do has probably shifted a little bit. We were on the phone yesterday with Northern Kentucky, and they have been, working with their manufacturers to do some things that they wouldn't normally do. Like helping them figure out how they can make PPE, or helping them connect with other manufacturers or service providers in the region so that, they can maybe source something that they're having a shortage of. It's just different things, helping companies get through the CARES Act. The CARES Act is, PPP is great for small businesses, but the CARES Act is a home run for some of your big corporations. And if you're not helping them make sure they get that, let me know, because I know some people that are really, really good at it and can help get that done. But it's, it's a big boon for them. And, it'd be great for them to be able to take advantage of it. It just makes them more likely to weather this storm. But so I think that some of the things may have shifted a little bit, what your priorities are, but I don't think that you should let up at all.
Marty Balsinger, I know we can always count on you for a question. You're unmuted.
Thank you, James. Thanks for doing this again. And Didi, good to see you and glad you're on here. Always some good information to think about. My question really prior to the coronavirus and the low unemployment rates in the Southeast states.
Mm-hmm.
I guess my question would be, was that perceived somewhat evenly? North Carolina, Georgia, South Carolina, it's hard to find people everywhere, or was South Carolina in an even more difficult situation from your perspective or your prospects' perspective, that it was going to be tough to find folks?
Generally speaking, I think South Carolina was like many other states where it was generally tough to find people, particularly in certain occupations. Mm-hmm. I think that in all states, there are certain metros or counties where there has been even tighter workforce, and specifically in Greenville and Charleston, Spartanburg, it is so hard. It is so hard for manufacturers to find jobs. To find workers to fill their jobs. And I think that, somebody asked me yesterday, how we were going to be looking at labor force after all of this. And I think this is such a crazy event that I think we'll probably have to look at what was the labor force like before everything started to shut down and people started losing their jobs. Because I sort of anticipate that it may take us 2, 3, 4 years, but I sort of anticipate that we'll get back to something like that sometime in the near future. And a lot of the projects I'm working on, it'll take them 2 years at least to get out of the ground and operating. And they're going to operate these plants for decades. These are multi-generational decisions. So I think they will, we'll try to figure out where is the norm and what we think the norm might be moving forward, but it's going to be a challenge.
All right, Didi. Thank you so much. That was a great session. We've had a ton of comments about how informative it was. Hey, to our guests that are here this week, we've got another session coming up 2 Thursdays from now. I would say we talk a lot, Stevie and I talk a lot about the blessings that have come out of the time that we've had off the road. Didi, I know like you're usually traveling, you're hitting a plane, come home, repack, wash the laundry, and then it's on the road again. Mm-hmm. To watch the leaves come out, to watch the grass turn green, to see our roses in the garden for the first time since we planted them has just been awesome. And then using stuff like this where we're reconnecting with friends and people in our profession and maintaining our conversations with people we would have seen at conferences has been hugely beneficial to our organization. So just don't forget in all of this that to count the blessings and make sure that you realize that there are blessings in all of this. So with that, Didi, thank you.
Thank you. Appreciate it.
Session. We'll see y'all in a couple of weeks.